morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. And the market's picture from an Indian market watcher's perspective may not be the most optimistic because the world markets are did very well. So US markets, for example, last night had a fabulous run, the biggest gains in a number of years. 1993, since 1993, I haven't had a single day gain like this, if I'm not wrong. Asia is doing reasonably okay. Nikkei, after having a 7% uptick in trade yesterday, is up another 5%. I don't know if the Japanese template is the template to follow. A lot of elderly population and still they're managing it very well. The markets are doing well, so maybe there's a leaf to take home from there. But anyways, I'm sure the regulators are doing what they are doing. Now, India, remember, for anybody who's not aware, but I'm sure everybody is aware because everybody tuned in to Prime Minister Modi's address last night. We are in a lockdown mode, and I reckon that is the reason why the markets are down today. 2.5% is what the SGX Nifty is indicating right now. We're likely going to start off lower if these cues are anything to go by. Let's see how we wade our way through that muddle after that. Let me get in somebody who actually who actually has advised us now almost every week once for the last 3 or 4, and his advice has proved to be timely and crucial. Independent emerging markets commentator Jeffrey Dennis joins us on the phone line from California. Jeff, before we start off with the markets, hope things are all okay out there in California. We've heard stories about things being grim out there too.
Well, we are in lockdown, but I think we're getting used to it, and it is what it is. You just can't go out except to go to the urgent shopping and maybe an exercise walk, but you get used to it.
India will now start getting used to it. 21 days of a lockdown, as I'm sure you've heard. Now, Jeff, let's come to what thoughts you have. I remember 3 weeks ago on a Monday, you told us that it's time to play the markets from a recession playbook. I think since then, the markets have come off quite rapidly, both global and local. How do you dissect the moves now that the Fed has come out with this bazooka of a stimulus? Can that alter the trajectory from the recession playbook trajectory that you would have thought we would be otherwise in?
I don't think, I mean, clearly what the Fed does, and presuming there is a fiscal package passed by Washington, which I think there will be, ultimately, it does provide some support for the economy and logically long-term for the markets. I think the issue is having seen the scale of this drop now, which is worth 35% from peak to trough over just 5 weeks, whether these policy moves mean we're somewhere near the bottom. I'm inclined to think that the daily volatility is still going to continue. I'm almost certain the daily volatility is going to continue. But I think you're somewhere near the bottom now. I think you'll probably hit new lows again, but I don't think we're going to go down another 15 to 20% from here because you've come down a long way. Clearly, some of the economic impact of this virus and the lockdowns you're getting around the country are being priced into the market now, and you are getting some significant policy support. But I don't think this is just, back up the truck and buy everything and we're going straight up because there is too much bad news still to come out yet, which is what's going to give you the volatility.
Markets tend to price in some of the bad news in advance. Jeff, you don't think we are there yet?
I mean, what I said to someone today was that it would be very unusual in a bear market driven by a weak economy, which of course is typically why you get a bear market, for the market to start recovering before you've even had much data giving you some idea as to how bad the economy is going to be. Now, typically what would happen is the market would bottom out as you progressed your way through the recession when there was some optimism the economic data was going to bottom out, or maybe, you were somewhere near the bottom. We haven't even seen any really major macro data yet. The March employment numbers will be interesting. The unemployment claims later this week will be interesting. Of course, the first quarter and the second quarter GDP will be very interesting. So, and if you put it in stock market terms, we don't know what the PE is because we don't know what the E is. We don't know what the earnings impact is going to be, except we know it's going to be very big. And so I think that I repeat what I said. I think you're going to get immense volatility here. I think the amount of downside direction from here will be relatively limited. But I think you've got a lot of volatility still to come. There is one other point I'd like to make if I've got a moment, that is this extraordinary suggestion from President Trump now that he wants to get the economy moving again from Easter onwards, I think played a role in the big rally today, because people said, well, if that's what's going to happen, that's going to cushion the blow for the economy. The problem with that is that twofold. Number one, that goes against the advice of all of his medical team. And secondly, point people should understand overseas is that he doesn't have the call on this. All of these lockdowns are being put in place in the United States by state governments. In California, by the governor of California, Gavin Newsom. So Trump can say what he likes about getting the economy moving again after Easter, but if the governors don't think it's ready, they're ready for that, the lockdowns will continue. So I think if that was one of the reasons why the market rallied today, I think it's probably not a very good basis for that rally, if you like.
Jeff, a follow-up really, since you look at independent markets as well, is the view, I mean, so SGX Nifty, for example, is pointing towards a downtick. I have a two-part question. Howard Marks in his memo said that typically, or I think not Howard Marks, but somebody else who I was talking to yesterday told me, or maybe it was Marks, I don't quite remember, but essentially the point was that the point of maximum pessimism arrives when there are no bounces. Right now, we're seeing a day of selling followed up by a day of sharp bounce, which means there is some optimism left. You reckon this will get over only when that point of optimism completely fades away? Would that be a template to follow?
Well, that's typically the thing people say. You know, you buy when there's blood in the streets, or you buy when everybody's sold, and you have complete capitulation. I mean, I do think this has been a truly dramatic, I mean, the data shows you that, a truly dramatic bear market over a very short period of time. And when you get something like that, you will always get bounces. And this was an extraordinarily strong one today. But I think that I don't think you've had necessarily complete capitulation yet. I think what's interesting about the emerging markets, and I wrote about this and put a report on an article on LinkedIn about it today, is that the emerging markets are actually pretty much down as much or no more than the developed markets this year, which means that unusually EM is not underperforming DM in this big sell-off. I think that's got a lot to do with China. Well, clearly it's got a lot to do with China. China's 36, and the index is only down about 15, 16, 17%, maybe 18% now on the year. And so I think the answer here is that once countries get to the other side of the virus, so you start to see some of these infections begin to slow, like you're getting in China and like you're getting in Korea, you know, economies will recover and markets will recover. With so many countries around the world, we're not there yet, as you know very well, looking at the situation in India. And so I doubt, as I say, to repeat, I doubt we're going down another 15% from here, 20% from the other day, the close. But I think you're going to have bad days with good days. You're going to have a lot more volatility still, because we've got a lot of bad news still to absorb.
Got it. Jeff, my final question. What about a market like India? I mean, everybody that I speak to, I mean, and frankly, when I look at the volumes, Jeff, they are very less compared to what you would typically get. I mean, we were down about 17% for the Nifty Bank, and we had only 33,000 crores, which is what, about $4 billion or slightly over $4 billion in the cash volumes. Now, my question is, would you reckon that people are negative right now on India because of the belief that the number of cases cannot be so low and they will go up at some point of time, and therefore go out and short the markets right now? Hedge funds may be doing that, and therefore is the market digesting the oncoming possible bad news in advance? Do you track India that closely now?
I think they're obviously discounting some of this bad news in advance. I think that may be part of the story. Of course, I think the issue with India, I think there's two things here. First of all, apart from all the flow of corporate bad news, of which there's been quite a lot, of course, is the realization that India, the economy, needs help now from the fiscal side. And we've seen a lot of interest rate cuts, so we've seen help from the monetary policy side. But it needs help from the fiscal side, both because the economy is weaker and because of the virus, potential virus spreading through the economy later on. and yet the room the government's got is very limited. So how much do they have in the way of, tools, if you like, policy tools to react to the weakness? If I may say the other thing, and this is not for me to say, I sit in California, it's easy for me to say this, and you're in India, but I was surprised by the lockdown coming so soon in India, because although you have cases of the coronavirus, you don't have many. And I suspect what the government's doing is they're saying, look, we don't want this thing to take hold in India because of the high population density, the number of people who live in difficult conditions in major cities, because if it does take hold, it will be very, very difficult to suppress. And so I think they've had to take these stringent measures, and taking these stringent measures, which will impact the economy further, it's not clear what weapons the government has got to sort of deal with that against the background where, as ever, of course, in India, the valuations are not cheap. So I think this is why India's usual defensive nature within EM is not coming through this time around, at least not at the moment.
Okay. Jeff, appreciate you joining us this late, but as I repeat, and I said the last time as well, we'd love to have you more often. You give us a lot of insights, and it's great having you.
Whenever. Okay. Thank you very much. Bye now.
Bye-bye. That's Jeffrey Dennis, emerging markets commentator, and somebody who's tracked EMs very, very closely, and therefore what he says in his independent role now also makes a lot of sense. Well, what is it? So this is a global view. What about locals? What is it that local experts are telling their clients to do? Well, one of the largest brokerages is ICICI Direct, and Pankaj Pandey of ICICI Direct joins us right now with his thoughts on how is he viewing the situation right now. Pankaj, what have you guys been telling your sets of clients to do? Are you telling them to start investing right now, or are you telling them to hold on because the markets today, quite unlike the other global markets, are down?
Hi, good morning, Neeraj. I think what we have been telling our clients is that it is still sort of early to tell that whether the market bottoms are made. But the way we have seen crack across sectors and stocks, the levels are definitely good. So depending on the risk appetite of an individual, they can have multiple options. So if the risk appetite is good, probably some bit of a lump sum buying can be done. In case if the risk appetite is not at all there, then I think people can or investors can wait on the sidelines and probably look for more clarity to sort of emerge, and then they can sort of participate. Otherwise, for a normal risk appetite, I think SIP kind of investing should continue. I think since we have seen cracks across all the most of the market segments, I think this is a good time to sort of upgrade to better balance sheet sectors, the likes of IT, pharma, and FMCG. I think that is one pack wherein we don't. So most of these companies in this segments are FCF positive, and our sense is that in case if because of this overall issue, if we get a financial squeeze or the companies are not able to raise funds the way it happens for capital-intensive sectors, then I think the order of preference again would be with these companies or these sectors. I think banking, we have seen a good amount of crack. So depending on the risk appetite, investors can look at the tier one banking names, because banking typically would be the first to sort of bounce back. Like I said, we still don't know how things could sort of pan out in the next few days. But I think next 1 week or 2 weeks is quite crucial in terms of how we sort of see the situation. But I think what is the market at this point in time is ignoring the so all the negatives are there in the prices. Negatives can sort of amplify also. But I think what is yet not factored in is the policy actions which the government can take. See, the Western world has largely sort of throwing money on this medical problem and hoping that things could solve. I think we have been slightly more proactive in terms of the kind of lockdowns we have done earlier and now this 21-day lockdown. And plus, in case if there is some medication hope, I think so if that is able to sort of flatten the curve, I think market is ignoring these positives at this point in time.
Okay, Pankaj, just one quick follow-up. Because of the sharp nature of the fall, have you heard of any issues with regards to settlements or margin calls at your broker, because you would be amongst the largest ones, and even in some of the others, or has it all been smooth sailing thus far?
So up till now, so for a broker like us, we haven't seen that kind of issue, but I would not sort of rule out for others, largely because since we are sort of largely online, so our margin requirements we had already raised. So from that perspective, we don't expect we'll be impacted. But
have you heard
about the other?
Have you heard about the others? I mean, I'm not asking you to name out, but have you heard such issues happening elsewhere?
So could be, but not to say that I would want to sort of comment on that.
No, of course not. No, I wouldn't ask you to comment on that. I was just wondering if you heard it or not, because in our checks with brokers thus far, we haven't quite heard of these issues crop up except for 1 or 2 days, especially on the down circuit day, and which is why I was wondering. Okay, Pankaj, stay on. Would want your thoughts on some stocks and news as well. Let me get in Shefali Malik, who first Johnson with all the stocks that we need to keep an eye out for in trade today. Shefali, good morning.
Good morning, Neeraj. So the first one is Reliance Industries. Financial Times reported that Facebook is in talks to buy a multi-billion-dollar stake in Reliance Jio, and the Facebook was already close to signing a preliminary deal for a 10% stake. However, the talks have come to a halt because of coronavirus-led disruptions. So that's one. The pharma stocks could be in focus, such as Ipca Labs, Cadila, DRL Sun Pharma, etc. As a notification by Directorate General of Foreign Trade, India has banned exports of the HCQS API, which is being considered for the potential treatment of the virus, and the exports will be limited to fulfilling existing contracts and on humanitarian grounds as well. So we can keep an eye on all these pharma stocks. There have been a couple of downgrades by Moody's. The first one is on Indiabulls Housing Finance. It has downgraded the company's corporate family rating and foreign currency senior secured rating, which has been downgraded to B3 versus B2 earlier, and the note says that the company's access to funding will remain challenging for longer than expected. So that's one. They've also downgraded ONGC's local and foreign currency issuer ratings, which have been downgraded from Baa2 from Baa1 earlier, and this downgrade reflects uncertain oil price environment, ONGC's depleted cash reserves, among other factors as well. And lastly, couple of companies have suspended operations because of the coronavirus impact. So we have couple of names like Apollo Tyres. They've suspended operations at couple of their plants till March 31. Nestle India, JK Lakshmi Cements, Pratap Snacks, VIP Industries, Goa Carbon. So the list is just going on increasing day by day.
Yeah. As it would, and we'll figure out some companies and notice them, some we won't even notice. But Shefali, thanks so much for putting all of these into perspective. Pankaj, this news flow around Reliance, I mean, we were talking about the Saudi Aramco deal possibility. Now, FT is reporting that Facebook might be in talks and almost ready to sign a multi-billion-dollar deal to take a stake in Jio as well.
So Neeraj, Reliance is something which is in our compliance list, so I will not be able to comment. But I think in terms of overall commodities, we are slightly skeptical, and largely because our sense is that road to recovery for them would be far more longer than for some of the domestic-oriented names, and which is why commodity overall looks like a sort of a value trap to us. And I think we would expect crude oil prices to remain soft for a good period of time, and which again would mean that deal happening will also take time. And since most of your Gulf nations have got a higher break-even for crude oil, so from a budget perspective, our sense is that the sovereign funds might be under stress, or they might have to sort of liquidate some of their holdings in both debt and equities to sort of. So from that perspective, I think the entire value chain does not look very clear in terms of the road to recovery.
Okay, but Reliance could be an interesting stock today. The market falling off might weigh it down, but this is a very interesting piece of information. And I think also the response to the tweet that BloombergQuint handle put out speaks volumes of that as well. Let's talk about maybe some charts and some derivative positions in not just Reliance but the markets too. Gaurav Bissa of LKP Securities joins us right now on the show, as does Chandan Taparia of Motilal Oswal Securities. Gentlemen, it's always a pleasure having both of you. Thank you so much for joining in. Gaurav, let's start off with you. How are you viewing trade today? If indeed we start off 120, 150 points lower, as the SGS is indicating, would you be tempted to take a trade, either upside or downside?
Good morning. These days I am not too tempted to take a trade just right away. One needs to be very careful. It's not just the levels. One will have to keep a very larger stop loss for the reason that you are playing with VIX above 80. And in this case, if you keep a small stop loss of intraday stop loss of say 50, 60 points, it can just go in a minute or two, not even a minute. So it becomes really difficult, and for that it has to be a very crucial level where you trade. If you look at the option chain or if you look at the yesterday's move, 7,500 commands a very good concentration, not the highest, but the good concentration is seen at those levels. So any move towards 7,600, 7,620 can be bought. Either one can buy a call option or one can buy a Nifty index with 100-point stop loss. And on the upside, 7,900 is what I would be expecting. We can see similar kind of move that we saw yesterday. That can happen, but it's good that if you open a lower node, people will get a chance to buy. I don't see too much of pressure happening below levels of 7,500 at least for today and tomorrow. And if those levels are approaching, then I think buying for a temporary bounce can be a good strategy.
Okay, so buying for a temporary bounce could be a good strategy, but it's fraught with risks. I think Gaurav Bisai has made it amply clear. Chandan Taparia, your view, and it could be materially different from Gaurav. What would you be doing today if we start off about 100, 150 points lower?
Very good morning. First, we need to understand that market is in a bear trend. We are making lower top, lower bottom from last 5 weeks, and every small bounce is being sold in the market. The India VIX jumped by around 16% on the last trading session, made high near to 86, close near to 83, and we are just near to its historical high of 92.53 made in 2008. So in such kind of volatile scenario, the roller coaster ride cannot be ruled out in the market. So it won't be easy for the traders to trade such kind of sense or such kind of move in the market. Looking at the options database, however, the put call ratio is near to 1.05, 1.11 level, but we are witnessing sustained call writing at all the higher strike. But good part is that on last trading session, some 4 to 5 lakhs open interest was seen in 7,500 strike. So that might provide some support, but frankly speaking, the trend is in pressure. If after the gap down opening Nifty manages to hold 7,500 zone, then definitely I can use this level just to play the bounce of 100, 200 points. But till market doesn't surpass 81, 8200 zone, I'll avoid to carry any short-term positional or overnight position in the market going forward.
Okay. What about specific stocks then? Gaurav, are you trading any large caps?
See, if you look at the setups, then one will have to look at the hourly setup because, as Chandan also mentioned, that many of the names, if Nifty is struggling to hold grounds, and the same will be seen reflected in the charts of many of the large cap names. In our previous conversation, also I had mentioned that since the large names like Hdfc Twins or Reliance, for that matter, Infosys, these are forming lower high, lower lows. The trend is still very weak. So we saw some of the bounce happening in IT names, but the sector is not still out of the woods. In that perspective, one will have to look at hourly charts to look for a temporary bounce back sort of if somebody wants to play for that. In that case, ICC is looking a little bit interesting. It's seen a small reversal from levels of 280 to 85, and it's sustained those levels. A small breakout if it holds 300. So in my opinion, 285 can be the stop loss, and one can buy for target price of 315. On the other hand, M&M consistently breaking the critical support area. Yesterday also it reached the support area of 280. Any jump towards 272 to 273 can be utilized to create fresh shorts in Mahindra and Mahindra. Stop loss of 280. You can slip towards the level of 255.
Chandan, what about you?
Yeah, looking at the market scenario, selecting one buy and one sell idea. However, trend is in pressure, but couple of stocks yesterday bottomed out and reversed sharply, including Infosys, HUL, and couple of other heavyweights. So that's why selecting to buy on Infosys in such kind of market, the stock has formed the ground and some sort of buying interest with long build-up is visible in the counter. So recommending to buy on Infosys with a stop loss of 564 and upside move to a 635 level. And second trade that is on the sell side, sell on the Vedanta. This stock is clearly in the bear grip, trading at the multiple years low levels. You've seen significant build-up of short position with negative rollover. Call writing is also visible. So weakness could continue to persist in the counter even if market recover. So selling on the Vedanta is advisable here with a stop loss of 67 and expecting this stock to drip down to a 57 to 56 levels on immediate basis.
Wow, yeah, commodities, and I think Pankaj laid out his view as well fundamentally on what to do with the commodities, and this is the other bit. Actually, I just want that one call, Chandan, from you on Reliance Industries too. It could well be the stock of the morning, and I'm quite unable to, it doesn't usually happen to me, I'm a bit unable to figure out what could happen to this one. It was a strong move yesterday. The news is positive, but the markets might just be weighing down on it. if Reliance starts off flat, Chandan Taparia, would you be inclined to take a trade here?
See, frankly speaking, not much convinced in such kind of market when volatility is near to 83. But yes, if it manages and satisfy my conditions, then I can play it for the options or for intraday point of view. Here, I want to notice one thing, that the stock is making lower top, lower bottom from last 5-6 weeks. But now it has come to the 2018 low support of 871. In 2018, the stock made low near to 871. Even on the 2 days back, it made low near to 875. So this 870, 875 is the cluster of the support. Worked 3 years back as well. Even the same support was respected 2 years back, 2 days back. So by looking the support of 870, however, that is comparatively much lower. So, but I think if it opens slightly down or a flat, I'll keep a wider stop loss of 875, and we'll play for a bounce to us 1035, 1039 levels on the upper side.
Okay, keep in mind, I think both our experts are making one point very clear, that they are not very keen to take trades. They might look at certain trades, they are giving it out so that people who want to trade might get these levels in place, but they're not very keen to necessarily take these trades on open. Maybe a good idea might be to wait for 15 minutes, see the direction, and then take a trading perspective. Now, one fundamental view from you, Pankaj Pandey, how do you view this this space of life insurance companies? They have all these stocks have come off and come off quite rapidly. I mean, yesterday's HDFC Life move being an exception, these stocks have also been battered. Do you find value here? Because these are businesses that technically don't get impacted because people don't go to office or production doesn't happen. There, unless people stop their policies, multi-year policies, business would be as usual. How do you view this?
So, Neeraj, I think fundamentally, if you look at compared to banks or within the BFSI sector, insurance and AMC is a slightly better off sector, largely because in banking, we are still not very clear what can happen on the unsecured side, because typically we have seen in 2008 whenever there is a crisis of confidence, the delinquencies in the unsecured portfolio goes up. So I think insurance does not have a problem like that. So which is why I think, like you rightly mentioned, I think this is one particular pocket which is slightly better off or can be slightly better off. Again, since this is a sort of out of syllabus problems, we don't really know the secondary impact which could happen if there is a crisis of confidence, because historical perspective is not at all there for a problem like this. But yes, insurance and AMCs look far more better in terms of the kind of damage what can happen compared to banks. So from that perspective, they are a slightly better place to look at.
Okay, let me ask you, Pankaj, then by the way, watch out for SBI Life and the other one too, ICICI. They've come down to levels from where they actually started that meaningful rally when people logged into these names. FIs logged into HDFC Life. Look at the cuts that have come into SBI Life, went up to 1,000. On the day of the budget, it got beaten down to 900 or sub 900, then bounced back. And now in 1 month has lost about 40%. That's very, very steep. Pankaj, quick 30-second, we will get the detailed view later. But what's that one pocket that you're keeping an eye out for whenever the trend changes? Or I'm not asking you when you would buy, because your buying might be staggered or you might advise buying at a later stage. But what's that one resilient pocket? Not a detailed answer, just a quick mention right now.
So I think resilience is largely there in the pharma side, which I think somewhere down the line post this issue, the focus on the healthcare is going to be far more higher than what we have seen historically. So my sense is that the entire pocket looks pretty attractive structurally.
Okay. So watch out for pharma, and we'll try and ask Pankaj post-market open about what within pharma and why, essentially, because there are API players, there are some of the other exporters, and there are local players as well, all of which it's a multifaceted pocket. It'll be interesting to see what within pharma could stand out. But 30 or 40 seconds left for the markets to kickstart trade. A quick mention of what Asia is doing. Mind you, Europe and US had a fabulous outing yesterday. Asia is taking on from there, and Nikkei, after a 7% uptick yesterday, is up another 5.7%. Hang Seng about a couple of percentage points. Shanghai has a gain of about 1.7. In the peripheral, other markets like Kospi, etc., too, are doing well. The SGX Nifty is not, unfortunately, 2.3% down. I reckon on account of the lockdown announcement and the resultant impact that people believe will happen on the GDP, and rightfully so. So That's something that is important to monitor as well. But let's see how we trade for the day today. The first rates on the pre-open, all over the place, of course, but yeah, 1.5%, 2% could well be it for the markets on open. Let's see what is likely to correct a bit. We're seeing some pushbacks. These pre-open rates are too messy, so keep that at the back of mind. They'll change. I don't know if a Nestle will have a 10% downtake or a Eicher Motors will have a 10% downtake, but that's what's visible right now. And I'm pretty sure that a Tech Mahindra will not have a 10% uptake either. So let's give these rates a chance to stabilize before we talk more about them. The one name that I think at the large cap end that we should discuss is Reliance Industries. Let's see how that has started off the pre-open session. Well, maybe likely to start off a couple of percentage points higher. Let's wait and watch what happens during the course of the day. And at the broader end of the spectrum, watch out for Strides, Godrej Consumer. Well, they look strong. Let's wait and watch if these last. And Interglobe Aviation and SpiceJet and Jubilant FoodWorks as well as Delta Corp are amongst the other names that you should monitor. Naturally, if there's a 21-day lockdown, no travel for 21 days, no amusement, and therefore no consumption, and therefore all of these stocks should be bearing the impact. Jubilant, I think, has said that the dine-in is shut, but the other facilities are open. Let's wait and watch how this now evolves now that we are in a strict nationwide lockdown for 21 days. So all of these stocks will likely get hit. Let's wait and watch what happens there. Pankaj, actually, just brief. By the way, keep in mind the money markets are shut today. Rupee and the bond yields will not be operational today, so we can't quite show them. Maybe the delayed impact on the currency will be seen tomorrow. The dollar is retreated across a bunch of other currencies. But Pankaj, just come in before we talk about pharma because you spoke about that. I just want to talk about this brief consumption pocket. What's your view? There are different facets. There are these exhibitors, PVR, Inox, which are shut and therefore problem. Aviation companies, and they have a problem. Some of these QSRs, and obviously they have a problem right now. And all of them have corrected. Within your coverage universe, where do you think the damage has been maximum? And maybe with some more price correction, they could actually become attractive.
So I think multiplexes are something which we have been liking earlier, and we've seen a good amount of damage already done in terms of share prices compared to, say, aviation or compared to, say, hotel as a segment. Our sense is that both aviation and hotel are quite sort of balance sheet heavy. Compared to that, multiplexes are low ticket consumption items, and going forward, our sense is that this is something which will see a faster pickup, and since we are not, and these companies are not balance sheet heavy, so I think that is a pocket we'll be focusing more on, because a number of movies have been deferred, and our sense is that probably going forward things could be slightly better for them. So I think that is one pocket one has to sort of look at within this kind of a space what you mentioned.
Well, I think this is a good view as well. Keep in mind, some of these companies will have repayments to be done, and we may wait for some extensions or some forbearances, etc., etc. But I think there will be some repayments that companies will have to do, and therefore leverage companies might have an issue. Compared to that, an Inox, which is not leveraged, might not have an issue. And that's one multiplex company that is, well, something that Pankaj Pandey was talking about. Watch out for some of the QSRs as well. One or two of them out of the 4 or 5 listed restaurants and QSRs don't have a major debt issue too. So you got to keep that at the back of your mind when you're looking at these names. Gaurav Bisa, any thoughts on some of these names? Is it possible to give a trading view here? A Jubilant FoodWorks, an Interglobe Aviation, maybe a PVR or an Inox?
So just looking at PVR, again, as I mentioned, that something if you want to play for the shorter term, and that is how one should be playing, it's very difficult to carry positions overnight. It's become quite risky for that. On hourly chart, it has given a decent breakout of around 1300, 1310. Any pull down towards 1340, 1345, which can happen, can be utilized. Trade a stop loss of 1300, can play for targets of 1400, 1420. For Jubilant FoodWorks, we have already seen a good move coming in. These are the names that are seeing bounce from the critical support areas as well. But we have already seen a decent move happening. So I would not be too keen. As far as Indigo is concerned, that is one name that one should be looking at least for a few days, for the reason that on weekly charts, the stock has formed a bullish harmonic pattern. And as long as it's trading above the levels of 850, 820, there's a possibility we can see some more upsides going ahead. As far as only trading is concerned, then the good supports are seen at levels of 880. If that is held on to, that can be used as a stop loss, and on the upside levels of 930, 940 can be expected.
Okay, but Gaurav, I'll revisit this interglobe aviation with you because the first 5 minutes show that it will start off about much lower than those support levels that you spoke about. So let's revisit that stock once the pre-open rates are settled or once the market open actually. Okay, Pankaj Pandey, pharma, that's something that you said is amongst the top draws for you. What within that pocket and why? You would keep an eye out for. I'm not saying you're going out and buying it right now.
Yeah, so I think we're clearly focusing on API players because given the fact that the government has come up with a new policy and going to sort of overall focus more on API players. So from that perspective, DVs and IPCA are something which we are clearly watching out. We've been liking it earlier also. I think these are attractive pockets. Then I think hospitals is something which we like. So both NH and Apollo Hospital is something which we like. Our sense is that going forward, public-private partnership would be the route going forward. And given the shallow penetration what we have in our country, I think this is something which is going to be a major focus of the government once this problem gets sorted. Then I think we are looking at domestic-oriented players, especially the MNC names, the likes of Abbott and Sanofi, where they are sort of they are operating in certain niche pockets and where penetration levels are not so high. So I think these are the kind of pockets. We are still not chasing exporters because our sense is that while exporters might get some bit of an interim relief in terms of, say, US FDA extending the expiry date or probably having a relaxed view on the kind of import alert, what they've been issuing or the kind of scrutiny they've been doing. But I think when things sort of normalize, probably life for them again could be tough. So that is something which we are not chasing. So domestic-oriented companies and API players is something we are clearly focusing on.
Okay. We will watch out for those names. As the pre-open rates settle down, IndianOpen Bank sees no favor, down about 6% as they are settling down. I think Asian Paints looks like starting off lower. Nestle looks like starting off lower. And ICICI Bank, etc., all are lower. Reliance Industries incidentally showing that gain. So mind you, the index is not doing all that well. By the way, the index is not doing that badly either compared to what the SGX was indicating. We're down less than 1% almost at the end of the pre-open session. So that's not too bad. And I think that might be in part courtesy Reliance, in part what the IT names are doing. Quite a spectacular move yesterday for Infosys. And in today's session too, Infosys and Tech Mahindra are starting off well. Chandan Taparia, any thoughts on Infosys?
Yeah, in fact, we recommended to buy on Infosys and we are recommending as a trading ideas for the day. We noticed that stock has recovered well on the last trading session and turning up from its multiple support zone. So already we are recommending to buy on Infosys with a stop loss of 560 and expecting it to move to a 635, 640 zone.
Okay, Pankaj, IT, any favors there?
Well, I think IT is a decent place to hide, largely not because we have a very clear view in terms of how the earnings would pan out this year. But our sense is that since their balance sheet is pretty good, tier 1 IT names is something what one can look at because we have seen a decent amount of crack in these names. Because see, in key geographies, the outlook is not very clear. In a US, BFSI sector can get impacted because of this overall virus issue, and we still don't have a clarity. So I think not really looking at it from a P&L perspective, but from a balance sheet perspective. So from a balance sheet perspective, these companies are pretty good. And I think near-term earnings is something which nobody has a clue at this point in time in terms of the kind of damage it will do. But historically, they've been trading at a lot more attractive PE multiples. And with the kind of correction what we have seen, I think they have become better. So from that perspective, tier 1 IT names are looking attractive. And it's a good place to hide.
Okay. So good place to hide indeed. Well, let's wait and watch what happens to these names in the course of the day today. Like I said, these are amongst the names which are standing out. So Infosys and Tech Mahindra in particular are actually standing out. By the way, not a surprise. It's a very strong quality name, Hdfc Bank. Just that the last few days it's been on a bit of a turmoil, but it looks like starting off in the green. It's a heavyweight, by the way. If Reliance, Hdfc Bank, Infosys all stay in the green, that's adding some bit of feet to the Nifty. So let's wait and watch if that happens. On the other hand, IndianOpen Bank continues to grind lower, as we said, 6.5% lower. We'll talk about IndianOpen Bank as a final thing with Pankaj Pandey and then thank him. But before that, since we're just 5 minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, Facebook is in talks to buy a multi-billion-dollar stake in Reliance Jio, reports the Financial Times. The deal would have in fact gone through if the global travel ban had not been put in place, adds the report. Ipca Labs, Cadila, Torrent Pharma, Dr. Reddy's and Sun Pharma in focus as India bans export of Trump-backed virus drug on demand surge per DGFT. Exports will be limited to fulfilling existing contracts on humanitarian grounds. Moody's Investor Service downgrades the corporate family rating and foreign currency senior secured rating of Indiabulls Housing Finance Limited to B3 from B2. Ratings agency expects that the company's access to funding will remain challenging for longer than expected. The ratings company also downgrades ONGC's local and foreign currency issuer ratings to Baa2 from Baa1 because of increasingly uncertain oil price environment, ONGC's depleted cash reserves and government guidelines that constrain state-owned enterprises' ability to lower dividends. India Grid Trust has executed share purchase agreement for complete acquisition of shareholding and management control in East-North interconnection. And lastly, CLSA says the COVID-19 impact on consumer sector is evolving rapidly, adding operating leverage is highest for hotels, QSR, multiplex and retailing companies. Discontinues coverage on Urban Fashion given lack of cash flow visibility amidst restructuring, upgrades Titan and Voltas but cuts the target price on them. Well, Titan is the other one which has been a joker in the pack, but well, we can only talk about as many companies. So Pankaj, I'm going to choose IndianOpen Bank to speak with you. Thoughts here?
So we were quite surprised with the kind of price damage it has seen within the banking as an overall pack. So from the management commentary or from whatever headline numbers are there, it is very difficult to sort of stitch up in terms of story, in terms of why this has seen this kind of a crack. But I think
fear
probably,
kitchen sinking, Pankaj?
Pardon?
You think people fear some more kitchen sinking?
So probably one could be that credit growth in the last quarter was pretty good, especially on the corporate side, and probably that might sort of lead to elevated level of stress. But then again, I think up till now there has been no sort of warning from the management, so which is where I think there's a clear disconnect between the share price performance and what the management commentary has been.
I guess so. Actually, just a very quick follow-up, Pankaj, before we let you go. ICICI Bank is showing some perverse moves as well, 4% down in today's trade too.
So I'm part of the ICICI group.
Okay, you can't comment on it. Okay, fair call. Pankaj, we'll leave it at that. Thanks so much for taking the time out.
Thank you so much, Neeraj. Yeah.
All right, that's Pankaj Pandey of ICICI Direct. Well, but hey, Chandan Tapare and Gaurav Bissar don't have any such compulsions because I'm not asking them about Motilal Oswal or LKP. So let me ask them about these two names. Chandan, I'll come to you first. IndianOpen Bank.
Yeah, first talking about IndianOpen Bank, you wanted to discuss about ICICI Bank and suddenly you moved to IndianOpen Bank. And this is one of the weakest.
You can talk about either one. Chandan, quick 20-second view. Any one of these names.
So expecting ICICI Bank to find support near to 278, but negative on the IndianOpen Bank and weakness could continue in IndianOpen Bank going forward.
Okay, so expecting ICICI Bank to find support, IndianOpen Bank, the weakness could continue. We're just a minute away from market open, and which is why this quick hurried views. Gaurav Bissar, to you, your quick thoughts on either of the two banks.
Yeah, I agree with Chandan. ICICI has a decent support levels of 278 to 80, and it's forming a rounding bottom on hourly charts. If this sustains, it can go back towards 300, and there would be a breakout above levels of 300 for levels of 315. So, in my opinion, if it survives about 270 to 80, this can see a quick move in next couple of hours towards the level of 310. So, in my opinion, between IndianOpen Bank and ICICI Bank, I'll go with the ICICI Bank.
Gentlemen, so let me try and ask you, I know you guys said that you should be careful with taking trades, but looking at the pre-open rates, etc., is there one stock that you would look to trade? Gaurav, I'll start with you first. Quick thoughts.
As I said, I would go with ICICI Bank among the two that I mentioned for the reason that it's trading in the support area. If it sustains to 78 to 80, the risk would also not be very favorable. Have a 5-6 point stop loss, and if it survives, it can go towards 300 in a very short period of time. Within a couple of hours. In my opinion, the risk setup is good in ICICI Bank. Don't jump right away, but if it sustains about 280, one can be long in ICICI Bank.
If it sustains about 280. Chandan, markets are starting. I'll be taking your call post-market open. But here's how we're starting off today for our markets. We'll start off, well, about 0.5% or there lower in trade. So it's not as bad as the XGS was indicating. Let's wait and watch if it tumbles further. The world markets, remember, are not doing all that bad. But banks dragging the indices lower yet again. In fact, the Nifty getting ready to break into the green. So it's not a bad start if you're a bull, really, or if you're an optimist. It's really not a bad reaction to the India lockdown. Maybe buoyed in part by the world markets and by the buoyancy yesterday. But let's wait and watch if this sustains. For now, the going is good. The Bank Nifty 2 clawing its way back. 1% higher for the Nifty 50. The SGX Nifty was very deceptive for open at least. Let's see what the first 15 minutes entail. The mid cap and the small cap indices should come up on your screen as well. And let's see how they are doing. Well, about 1% lower for each of these, but I think most people would have taken this reaction with both hands. 1.25% up for the Nifty 50. A really strong start. Let's get the heat map up on the screen. The numbers that matter are here. The stocks that are leading them to do this. Reliance Industries, the key one. 6% higher. The story that got done or got published in Financial Times, of course, earlier, but we put it out as well, and that's having its impact. Z is about 4.4% higher. Hdfc Bank is putting up a strong show, by the way, 3.5% up for this one. Bajaj Finserv, Adani Ports, HDFC itself is doing well, about a couple of percentage points. So some heavyweights are actually in the green. TCS, I think, is also about 1.5% higher, and which explains why the markets is actually doing well, because the heavyweights are gaining. What is losing? IndusInd Bank, Ultratech, Maruti, Larsen & Toubro. Well, this is very interesting price patterns. I must say the two disappointments would be Axis Bank and ICICI Bank, somehow not able to find favor. And as we speak, about 1.5% higher in trade. This is a really strong move by the Indian bourses on open, and Reliance is leading the charge. 7% for Reliance Industries. This stock, we should just get that stock once up on the screen before we get to some of the others. Let's just pull up Reliance Industries on open, because this is frankly the one that is helping the index right now. 7.5% for the proposed deal between Facebook and Reliance Jio. Not only have Aramco and the refinery deal, but we now have a Facebook and a Jio deal. So the debt concerns around Reliance Industries might be the thing which in investors' mind might be moving away or dissipating a little, and which is why this strong move. 8.5% for Reliance Industries. This is that one stock that you got to monitor. 9% now up. I can't get my eyes off from Reliance Industries. It's slowly moving to a 10% move in Reliance Industries. Frankly, that one stock that matters in the Indian markets on open today. Really strong move. Let's see if this lasts. But we got to look at the other markets too, other stocks too, very quickly. Just one set of stocks that I want to highlight before I take back to our technical experts, and which is those multiplex stocks or QSR stocks. And we should pull up the likes of Jubilant FoodWorks or Interglobe Aviation, etc. And let's see what they are doing in trade. Well, all of these start off lower. The lockdown will have an impact on the business models of each of these, and therefore they start off lower in trade. But first, I know Mihir Vora is with us, but I have to ask our technical experts for their view. Chandan Tapari, I couldn't take your top call view. You want to give that and a quick thought on Reliance Industries, this big move that we're seeing in that stock. Do you do anything here?
Yeah, Reliance already we discussed that the stock has taken support at 2018 low of 871, 875 zone, and now it seems that it has already formed the bottom, and now the stock has potential to move on higher side. The stock opened at 963, that is the opening and low, and that will be a support. So one can take any positions on any small decline or current level with support of 965. And the way it is moving, the stock has potential to move towards 1100 kind of level. And talking about the trading ideas, I'll here recommend to be with Infosys, recommending to buy on Infosys. This stock has already formed the bottom. And I think these couple of stocks has potential to pose the recent meltdown of the market. And that looks quite encouraging. Now I have to look at the cool down the volatility that will more confirm. So trading idea is buy on Infosys. The target was 635, but already stock has open positive. So now I revise support to 575 for target of 635 and then 666.
Okay, Gaurav Bissa, one quick thought from you. Would you be a buyer in ICICI Bank? Do you think it's taking support, or would you wait for the first 15 minutes?
Generally wait for first 15 minutes, and as we discussed, once it holds 280, we can see some spikes. So it has seen a spike. Now one should buy once it holds about 300, because then there will be a decent breakout, and on hourly charts also there's nothing between 300 and 315. So in my opinion, that can be a good trade if it trades about 300, sustains it for some time, even for 5 minutes. One keep a stop loss of 294 and play for targets of 315.
Okay. Gentlemen, both of you, on an important day like this, thank you so much for taking the time out and speaking to us. Appreciate your time. Well, get in Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us right now on the show. Mihir, we've been used to getting you in our office, so this seems a bit different, but nevertheless, times are such. Thanks so much for joining us today, nevertheless. What's your sense, Mihir? The economic impact of a move like the lockdown announced yesterday, and maybe possible further moves as well, is a bit of an unpredictable entity. How are you viewing investing in such a scenario?
Good morning, Neeraj. Yes, these are unique times. Frankly, it's very difficult to take any call at this point in time. The only thing that I can see that what we have seen in the last 1 week is that we haven't seen too many positions left in the market. So if I were to look at, say, the situation 10 days back, there was a lot of futures positions in the market as far as the FIs are concerned. But now, if I see the numbers, there are hardly any positions left in the market. So it's a very shallow market. The prices that we are seeing now are really based on very low volumes and created by liquidation of margin trades or we've heard some cases of ESOP funding, etc. So these are shares which are not being sold by rational analytical people like, say, fund managers or analysts, but these are basically sold because of financial needs or basically cash needs, so to say. So in this situation, given the way the lockdown is something that we've never heard of, never thought of, it's very difficult to take up any really good judgment on this, frankly. Obviously, there's going to be a recession globally. The June quarter numbers are going to be terrible. But I think the way the prices are there, probably, we'll have to bear the pain for some time, and hopefully there's limited downside.
So, Mihir, in your assessment, are the markets, I mean, even if they are up 2%, largely led by Reliance, a large bucket of stocks are still in the red. Do you reckon that the markets are pricing in some of the impact of an extended lockdown situation as well? Is it possible to kind of guesstimate that?
Very difficult because this is not a situation where you can quantify the impact because there is the immediate loss of GDP, which is obviously going to be there since we are not doing any activity, and then there will be the secondary impacts in terms of job losses, bankruptcies, defaults. So it's very difficult to quantify the second and third order impact of this. It's for this reason that it's very imperative for the government to step in and also come out parallelly with a plan to save businesses and individuals, because just a lockdown is fine because we need to contain the epidemic. There doesn't seem to be any other solution, but it has to be mitigated by certain fiscal measures, and I hope the measures are coming sooner rather than later.
Mihir, just a couple of minutes that I want to spend time with you on. How do you think the market is looking at the banking space right now? One, fundamentally, and two, the kind of price damage that we're seeing on fairly limited volumes of selling as well. I mean, I was just surprised that the other day when we fell about 16-17% for the Nifty Bank, the cash market volumes were just about 33,000 crores. So it's not very high. So one, the fundamental gauge, and then the technical pressure, because almost everybody that I speak to seems to suggest that this is algo trading or algorithmic selling that is happening, which doesn't quite look at valuations, just places the sell order. How have you analyzed this?
So there are, in my view, 4 factors or maybe more, but let me just go through them one by one as far as banking is concerned. One is that algo trading angle is correct. You may see a lot of ETF liquidation because the market volatility has gone up. So a lot of these hedge funds and ETF linked exposures are linked to volatility. And when vol reduces, they increase exposure, which is what the situation has been for the past 1, 2, 3 years. We had a very benign market, very steady market going up with low volatility, which means that they were increasing exposure all the time. But in the last 3 weeks, we've seen gut-wrenching volatility, which means that they have no choice but to limit the vol and limit the exposure. So they have no choice but to cut exposure. So that's the reason why you are seeing a lot of probably ETF-based selling, because these are, they have a limited risk budget, and that risk budget is a function of volatility. Higher the volatility, lower the risk budget. So that's why they are liquidating stock. Second is, as far as banks are concerned, it was anyway one of the most popular segments to be in, especially the private sector financial space. It has a 40% weightage in the Nifty. So obviously, when you have liquidations towards India or redemptions in India, minimum 40% of sales will come in this segment. So obviously, there's a supply issue there. Third is that we also hear of certain cases in which a lot of ESOPs were issued to employees, and to fund the ESOP premiums, probably some of the employees had taken loans, leveraged loans, which also had the original probably shares as collateral. So with the share value going down, you need to top up. Make up the difference in cash or top up, which if you don't have, then the financier would liquidate the stock. So that's also something that we have seen in certain mid-cap names. And the fourth angle is that, that we just talked about. When you're talking about such a gut-wrenching economic slowdown, you are talking about second and third order derivatives in terms of small and big business bankruptcies, or stress, financial liquidity stress, and job losses. So not only are we likely to see stress in the corporate sector, but we may also begin to see stress in the retail sector because of job losses and lack of income for extended periods of time. So a lot of the retail-oriented NBFCs and banks, which were so far unaffected even by the corporate slowdown, are beginning to see those concerns being priced in.
I wonder, Mihir, the Aditya Puri con call, wherein he mentioned, he gave out statistics for his bank, of course, but that, that of the unsecured book as well, some of it is cards and some of it is given out to salaried people who are amongst the top corporates, and therefore they will not be hand to mouth. I think that was the implication drawn. The market doesn't seem to be making a distinction, or in that, of course, it is making some distinction, because the likes of IndusInd Bank, etc., are just continuing to be taken to the cleaners, whereas Bajaj Finance and HDFC have moved up a bit. But do you think that the price damage on some of the bluest of blue chip financial names is a bit overdone, or is it difficult to say? Because I would presume that if while the landscape has changed, for balance sheets to come out and do well, it would be some of these which would do that.
Absolutely. So when the economy turns, it's not a question of if, it's only a question of when the economy turns. These will be the same set of financials which will drive the market up, because they still have a large weightage. But what we are seeing now is just liquidation based on money requirements, not based on any fundamentals or price or valuation, frankly. So it's just a question of temporary supply and demand in that particular stock at this point in time. So I don't think we should read too much into the prices. I don't think anybody's out there taking a rational call on whether the NPAs will spike from 0.5% to 2% or 3% or 1.5%. I don't think anybody's making those kind of calls. It's just that some funds or some individuals need money and they're selling.
Okay. I just want to take a moment and get Mihir's view on a chart that I want to lay out on our wall as well. This is a Bloomberg chart, and I'll just walk across because it shows what happened in the past template that we compare the current situation to. And this is the Asia companies profit estimates, of course. And watch this. This is as per the latest data available with Bloomberg, the cut in estimates, earnings estimates for the Asia Pacific region, about 13.4% thus far. From the time the meltdown started. Compare this to the earnings cuts that happened back in 2008 global financial crisis, about 58% or 59% annualized, but 58 odd percent for that period. Now, Mihir, my question is this. We let's assume for a moment's sake that we find a cure and the bad news around the pandemic goes away. But the bad news around earnings may not necessarily go away in a rush. If anything, for the next couple of quarters, we might keep on listening to that. Do you think that will keep the market under check? Or do you think the markets will discount that and think of the recovery 6 months out?
Sure. So our base case is that, the economy will go through a V-shaped recovery, probably in the September quarter or so, or maybe a little later. Because there is no choice for global and Indian government and central banks to basically, pull out all the stops, whether it's fiscal or monetary. I think we are a little bit behind the curve probably, but at some point in time we'll have no choice, and I think the markets and the economy will force the authorities to do that. So as and when that happens, you'll have a huge amount of inventory restocking, pent-up demand, etc. in a lot of segments. Probably the services segments is something that you can't have inventory for. But at least on the manufacturing side, there'll be a lot of pent-up demand, and we will see a V-shaped recovery. The rate at which the markets are falling, probably you might see the markets bottoming out a bit more before that.
Okay. Mihir, one last question. A lot of people that we've been talking to have been talking about whether they are with the cash that they had or the cash that they are getting and what they are doing, whether they're starting to deploy 15%, 20%, 25%. Is there a sense that you can give about what your thought is? If you had cash, for example, and if you're getting new cash, what would your template be and why?
So we've been deploying on really bad days, like when the markets are in a real panicky. So we're putting a bit in, not going all out, I would say, but definitely looking at stock specific. Even the large caps. Some of the large caps are down 40, 50, 60%. So there is value out there being created. And we also must remember that the markets will bottom out at on a day. That will be the Nifty will bottom out on a particular day. Whether it's 1 week down the line, 1 month, or 2 months or 3 months down the line, we don't know that. But not all stocks will bottom out at the same time. So even when the Nifty has fallen, say 30%, there are stocks which have fallen 60, 70, 80% in some cases. And these are stocks which are going to survive, which are going to thrive when the economy turns around. So I think it may not be the best of ideas to wait for that particular day on which the Nifty bottoms out, but also keep an eye out for individual stock price movements.
Okay. Mihir, if I can ask you one final question, and you may choose not to answer it, but there's some interesting thoughts about how people's behaviors change after every large event. And one of the thoughts that was expressed was that people's behavior towards insurance might change a bit post this event, because people might start believing that it's very, very important to insure lives, have higher mediclaims, so on and so forth, etc. You are kind of associated, so I don't know if you want to respond to this or no, but purely as an investing mind, would you believe that the damage in the insurance companies provides with a chance to buy, because those businesses might anyways not get damaged too much, and post this is over, there might be a bit of a beeline to increase or take fresh insurance covers as well, both life and general?
A difficult one, frankly. It's not like insurance stocks haven't fallen. Even the insurance stocks have fallen in line with the rest of the private sector banks, etc. So I think the relative valuations still remain where they are. But having said that, probably there might be a bit of a rub-off once the lockdown is once the lockdown is lifted. There might be a bit more of interest than before, but difficult to speculate at this point in time.
Speculate, I think that's the right word. So if you indeed hear talks about that, maybe it is speculation right now, because it's very difficult to say with certainty. But Mihir Vora, take a moment to thank you for joining in today and giving us your thoughts. Stay safe. Well, that's the view from Mihir Vora of Max. The markets have quickly settled back to the basic template of seeing the Bank Nifty correcting. I wonder what Reliance is up to. Just want to mark that once and see what that stock is doing. It was up about 9.5%. It's still 7%. So imagine the indices are getting ready to break back into the red, despite Reliance being up 7%. And that means that some of the banks are taking a nasty cut. IndianOpen Bank down about 5.5%. Axis another 4.5%. It's now sub 300 Axis Bank. So clearly the market is really worried about something out here. ICICI Bank is the other one, 3.5% lower in trade. And Hdfc Bank, which was in the green, let's see if it still is. Yes, it's still in the green, about 1% higher, but that's about it. But clearly the market's worried about some of the other private sector banks. State Bank of India itself is down about 1.5%. I think the pain in SBI has been quite exemplary. Just before we wrap up the show, if we can pull up the 1-month chart of State Bank of India, it's trading at 180. It was at 320 or 330 around the time of the SBI Cards IPO first starting to get announced. From there, it's lost 44% in 1 month. And clearly the markets are worried about what will happen to asset quality issues and some others. But yeah, some clear and present dangers for some of these stocks. Anyways, viewers, thanks so much for tuning in for this. We'll of course be back with more market action as well during the course of the day. And if a big event happens, then we'll cover that too. But thanks so much for tuning into this leg of Indian Open from me and the entire team that put this show together.
According to a recent report, women today contribute